Where will the AI bubble burst?
Over the past 3 years, the stock prices of AI technology companies have skyrocketed, and NVIDIA has risen to become the #1 company by market capitalization on the NASDAQ and the world. Led by NVIDIA, the stock prices of companies in SOX have increased by nearly 2.7 times.
As of 2026, the media and experts are assessing the possibility of a bubble in the AI industry based on two key keywords: pressure to prove profitability and infrastructure bottlenecks.
The key evaluation details are as follows.
The biggest concern is that actual profit generation is slow compared to the astronomical investment costs.
MIT researchers analyzed that about 95% of generative AI investment organizations have not yet generated significant returns.
There are increasing concerns that the massive costs associated with training and operating AI models are placing a significant burden on corporate profitability.
While semiconductor supply was an issue in the past, securing power has now emerged as a key variable for AI growth.
Energy shortage. Warnings are emerging that the pace of performance improvement and adoption could slow down as supply fails to keep up with the power demand caused by the surge in AI data centers. Infrastructure dependency. The fact that the global economy relies excessively on AI capital expenditures is also cited as a factor that could amplify the shock in the event of a bubble collapse.
Despite concerns about an AI bubble, positive views regarding the long-term growth potential of AI still coexist.
Optimism. The global AI market is projected to grow rapidly, from approximately $391 billion in 2025 to $1.81 trillion in 2030. Cautious view. Wall Street experts are watching the possibility that the bubble will be adjusted as the overheated investment fever cools down starting from 2025-2026. While the media currently agrees that AI is a technology that will transform the economic structure beyond a mere fad, they predict that selective restructuring will occur, centering on companies lacking realistic revenue models.
Then, who are the companies that lack realistic revenue models?
It is the most innovative group, but at the same time, it spends the most and is recording a deficit.
OpenAI, it recorded a loss of approximately $5 billion in 2024 and is expected to see a cash burn of about $8 billion in 2025 and a larger amount in 2026. Despite rapid growth in annual recurring revenue, ARR, the costs of model training and inference are outpacing revenue.
Anthropic, reported to have recorded a loss of $5.3 billion in 2024 alone. While it is spending astronomical amounts on cloud infrastructure and GPU resources, the timing of a clear turnaround to profitability remains unclear. These are companies that provide services by taking APIs from existing LLMs, such as OpenAI, and merely changing the appearance, without possessing proprietary technology. Lack of entry barriers. If large model developers release similar features for free or raise API costs, it faces an immediate business crisis. Low profitability. With high infrastructure costs and low customer loyalty, pessimistic forecasts suggest that 80 to 99% of AI startups will disappear by 2026. These are companies that have boosted their stock prices solely through the announcement of AI adoption without any concrete AI revenue models. Failure to prove profitability. According to MIT research, 95% of organizations that have adopted AI are not yet generating a measurable return on investment, ROI. Infrastructure sunk costs. An increasing number of companies are facing an impairment crisis as they made preemptive investments in areas such as the construction of large-scale data centers, but the actual demand for paid services utilizing these facilities falls short of expectations. In summary, the current market has begun to strictly distinguish between companies that sell infrastructure like NVIDIA and companies that actually make money by using AI. Companies that do not fall into the latter category and are merely paying massive GPU rental fees are currently being cited as the top candidates for a bubble collapse. However, the actual collapse of the AI bubble is currently beginning with distress in the private credit market,
The fund run in the private credit market, which started with the suspension of redemptions by Blue Owl Capital, is now spreading to Blackstone, BlackRock, and major firms.
Some companies have suspended redemptions indefinitely or entirely due to liquidity depletion and falling asset values. Blue Owl Capital has permanently suspended redemptions for its OBDC2 Blue Owl Technology Finance Corp. II fund, which specializes in lending to technology companies. This is due to growing concerns over loan defaults in the sector, stemming from fears that AI will cannibalize the existing software services sector. MFS, a UK-based private equity firm that recently entered receivership and suspended redemptions. Barclays share price has recently plummeted because the risk of loss has been highlighted due to its approximately £500 million bond exposure to MFS. The bankruptcy of MFS has spread negative sentiment toward the private credit market, raising concerns about banks' lending practices and risk management. This is a case where payments are not completely suspended, but are being made only within quarterly, monthly limits, gate applied, due to a surge in redemption requests. The world's largest corporate lending fund, CCLFX, Cliffwater Corporate Lending Fund, has imposed restrictions by paying out only half of the requested redemption amount. Morgan Stanley announced redemption restrictions on its private debt fund and entered standby mode. BlackRock began strictly applying a 5% quarterly cap as redemption requests surged at HLEND, which is operated through its subsidiary HPS. It is effectively controlling redemptions by drastically reducing the monthly redemption limit of its real estate private equity fund, S-Right, from the existing 2% to 0.33%, 0.5%. Blackstone BCRED, the flagship private debt fund, received a record number of redemption requests amounting to 7.9%, $3.8 billion, of its total assets. Despite its redemption limit of 5%, Blackstone averted the crisis by temporarily raising the limit to 7% and directly injecting approximately $400 million in funds from the parent company and employees to fully accommodate the requests for this quarter. With the emergence of high-performance AI, such as Anthropic's Claude Cowork, fear has spread that existing software companies will be unable to make money and repay their loans. A liquidity crisis occurred as a large influx of funds from individual investors into the private lending market, which is not subject to bank-level regulation, was followed by a sudden withdrawal. This is the crisis in the current AI market pointed out by the media and experts. However, I believe the biggest risk factor for the current collapse of the AI technology market is the liquidity crisis faced by small and medium-sized data centers that borrowed from the private lending market to purchase NVIDIA GPUs. In other words, companies aggressively expanding their data centers by securing private credit using NVIDIA GPUs as collateral are referred to as NEOCloud companies. And we assess that these firms are currently facing a liquidity crisis due to the credit crunch in the private lending market. These are small to medium-sized specialized cloud providers seeking to build their own AI infrastructure without relying on big tech, such as Microsoft and Google. And some of them are companies that pivoted from former Bitcoin mining businesses into data centers. Let's examine the current lending situation to see why these NeoCloud companies are risky. GPU-backed lending leader, NeoCloud. These are the most representative companies with a structure where they borrow money using chips as collateral to buy chips again. CoreWeave. As a leader in this field, it holds over $14.2 billion in debt as of 2026. Loan structure? It has repeatedly executed multi-billion-dollar loans from clients such as Blackstone and Magnetar using NVIDIA H100 GPUs as collateral. Data centers. It operates over 28 data centers across the United States and leases infrastructure to major AI labs, including OpenAI. Lambda. Current status. Starting with a GPU-backed loan of approximately $500 million from Macquarie and others, the company subsequently entered into a $1.5 billion GPU leasing agreement. Notable features. As a partner directly invested in by NVIDIA, it operates a GPU cloud specialized for small startups and research labs. Crusoe Energy Systems. Current status. Originally a cryptocurrency mining company, it pivoted to the AI cloud, securing a loan of approximately $200 million from Upper 90 and others to acquire over 20,000 H100s. Strategy emphasizes eco-friendly AI infrastructure that utilizes gas energy wasted for data center operations. FluidStack. Status:
a London-based startup that surprised the market by reportedly receiving loan approval of over $10 billion, or approximately 13 trillion won, from Macquarie and others.
These are companies primarily listed on the NASDAQ, but smaller in scale compared to big tech, and are expanding their infrastructure through aggressive debt strategies. Applied Digital. With support from NVIDIA, it is directly constructing next-generation GPU data centers and actively raising funds through asset-backed securities, ABS, or private debt secured by them. Iron. Iron is converting its Bitcoin mining infrastructure into an AI data center and is raising funds to purchase GPUs through private funding.
Major private equity funds that lent money to them. These are major lending institutions that could act as the trigger of a bubble. Blackstone led the largest private loan in history, $7.5 billion for CoreWeave. Magnetar Capital, a key strategic lending investor in NEOCloud companies. Macquarie Group executes large-scale GPU-backed loans for Lambda, FluidStack, and more. BlackRock, PIMCO, Carlyle participated in loan syndicates such as CoreWeave. The serious problem is that the debt of these companies has now exceeded $20 billion, accounting for a substantial portion of NVIDIA's revenue. If these NEOCloud companies fail to repay their loans due to unprovable profitability of their AI models, there is a high risk that this will lead to a chain of defaults in the private debt market, accompanied by a collapse in the resale value of the GPUs held as collateral. I will show you the figures for a specific company among these that has reached the most dangerous level of financial health, debt ratio. As of March 2026, CoreWeave, CRVW, is assessed as having reached the most dangerous level in terms of financial health among companies expanding GPU infrastructure through private financing. Even after its recent NASDAQ listing, CoreWeave continues to aggressively raise debt and uses such high leverage that rumors of a technical bankruptcy crisis are circulating. Debt-to-equity ratio. As of the end of 2025, it stands at approximately 640.9% to 894%. Considering that the debt ratio of typical blue-chip companies is around 100% to 150%, this is a very dangerous figure. Total debt amounts to approximately $21.4 billion, about 28 trillion won, of which about $3.6 billion is short-term debt maturing by June 2026. High interest burden. Due to the nature of private loans, interest rates are very high at 9 to 15%, and annual interest expenses alone amount to hundreds of millions of dollars, widening the net loss. Capital expenditure, CapEx plan. With an additional investment of $30 billion to $35 billion projected for 2026 alone, the size of the debt is expected to increase further.
Why is CoreWeave the most dangerous? CoreWeave's model is an infinite loop structure of borrowing money using NVIDIA GPUs as collateral, using that money to buy GPUs again, building data centers. Decline in collateral value. As NVIDIA releases new chips such as Rubin every year, if the value of older GPUs held as collateral plummets, private equity firms may demand additional collateral or recall loans, margin calls. Deteriorating profitability. Cost expenditures are outpacing revenue growth, with the company projected to record an annual net loss of $1.17 billion in 2025. Notably, based on the most recent results for the fourth quarter of 2025, interest expenses stood at approximately 24 to 25% of revenue, a figure that surged by about 160% compared to the same period last year, $149 million. Due to massive debt financing for AI infrastructure expansion, interest expenses are growing faster than revenue, which significantly widened the net loss in the fourth quarter, $452 million.
Who is next? It is Iron. Why is Iron dangerous? As of March 2026, Iron, formerly Iris Energy, is a company that has undergone a rapid transition from a Bitcoin mining company to an AI NEOCloud, and I guess it is currently conducting a large-scale at-the-market ATM capital increase of $6 billion due to a liquidity crisis. The main background and current status of Iron's liquidity crisis and paid-in capital increase, as I speculate, are as follows. Iron has already exhausted its $1 billion capital increase limit set for August 2025 and announced a new plan on March 4th to significantly increase it to $6 billion. Massive dilution. $6 billion amounts to about 40 to 50% of Iron's current market capitalization, and the stock price plummeted in the short term as fear spread that the value of existing shareholder stakes could be diluted by nearly half. Experts and short-selling investors, such as Jim Kanos, are raising suspicions that Irene may have chosen an excessive capital increase for survival rather than growth. Massive capital expenditure, CapEx. Aaron plans to purchase over 50,000 of NVIDIA's latest B300 GPUs to build a fleet of 150,000, and to do so, it needs billions of dollars in cash immediately. Delay in revenue generation. It is analyzed that the company is seeking to secure cash by selling shares directly on the market to make up for insufficient operating funds, as it has become uncertain whether the revenue target for the AI Cloud division, annual recurring revenue of $500 million, can be achieved. Debt repayment pressure. It is a critical time to raise capital to reduce the interest burden on the previously executed GPU-backed loans and convertible bonds.
In conclusion, Iron has made a final gamble by borrowing shareholder money to translate its powerful weapon, its currently secured power infrastructure, 4.5 gigawatts, into actual revenue. If it fails to demonstrate significant AI revenue by the second half of 2026, it appears highly likely that the risk of collapse due to liquidity depletion will materialize. Furthermore, given that Bitcoin mining margins are expected to be virtually non-existent after falling by over 40% from last October to the present, I assume the next quarter's earnings will likely be the worst performance yet.
The Iran War, a war for survival for NEOCloud companies. The surge in oil prices caused by the war in Iran could be more than just bad news for NEOCloud companies. It could become a fatal threat that shakes the very foundation of their business models. The reasons for this can be summarized into three main points.
NEOCloud providers, CoreWeave, Iran, Navius, etc., operate massive data centers running tens of thousands of NVIDIA GPUs. Electricity cost proportion. Electricity costs account for approximately 40 to 60% of data center operating costs. Soaring oil prices lead to higher power generation costs, which quickly erodes the operating profit margins of NEOCloud companies. In particular, if there are many clients with long-term contracts at fixed prices, the inability to pass on these increased costs to customers can widen the deficit. Spot pricing exposure. Iran switched to spot pricing to lower electricity costs at its Childress, Texas facility, utilizing low-cost electricity at a rate of approximately 3.0 cents per kilowatt-hour as of early 2025. However, spot prices react immediately to market fluctuations, as natural gas prices surged in the aftermath of the war, leading to a corresponding rise in wholesale electricity prices on the Texas electric grid, ERCOT. Iran faced much more direct and rapid cost increases than fixed-price contractors.
As mentioned earlier, companies like CoreWeave spend about 25% of their revenue on interest expenses. Inflation and interest rates. Soaring oil prices stimulate inflation, which leads central banks to maintain high interest rates. The decline in the U.S. stock market on March 20 was due to the expectation that there would be no possibility of the Fed cutting interest rates in 2026. Cutting off funding. NEOCloud companies expand their businesses by taking out trillions of won in loans using GPUs as collateral. If interest rates do not fall, the burden of interest payments may make new facility investments impossible or push them to the brink of bankruptcy.
From last year to this year, executives of major NEOCloud companies cashed out by selling massive stakes amidst soaring stock prices. However, it appears that many individual investors are still approaching investments with unrealistic expectations regarding AI data centers. Currently, rather than relying on the sweet words, narrative of NEOCloud companies and their management, investors must apply the numbers on the financial statements and the reality that the private debt market is collapsing due to the current credit crunch to their investments. While the risks in the private debt market are largely overshadowed by the Iran war, fund redemptions are being suspended or restricted across the board, ranging from Blue Owl to the megacorporation BlackRock, and this issue is impacting not only the stock prices of private debt firms, but also the financial sector as a whole. However, among the tech stocks I observed last Friday, March 20th, the stock price movements of AI NEOCloud companies appeared to be in the most dangerous state I have seen. This is because the proportion of retail investors is increasing rapidly. In the following analysis, we will examine the starting point of NEOCloud's corporate crisis. It is likely the company you are imagining.